the best of money matters. Under the radar.
You're listening to Money FM 89.3, and it's now time for Under the Radar with me, Chua Tian Tian. Let's back to the real estate sector today as we speak to an SGX-listed REIT focused on commercial properties in Europe. Now, founded in 2017, Stoneweg Europe Stapled Trust is a stapled group that comprises Stoneweg E-REIT and Stoneweg European Business Trust. You might better know the REIT by its old name, Cromwell European Reit, before it was bought over by alternative investment group Icona Capital and real estate investment group Stoneweg for 280 million euros, or around 395.5 million Sing dollars just a couple of months ago. Now, Cromwell European REIT was renamed as Stoneweg European Reit at the start of 2025 and later converted into a stapled group in June 2025. Today, the stapled trust has a principal mandate to invest, be it directly or indirectly, in income-producing commercial real estate assets across Europe. In particular, the trust needs to maintain a minimum portfolio weighting of at least 75% to Western Europe and at least 75% to the light industrial or logistics and office sectors. On top of that, the trust also takes on asset enhancement and redevelopment projects for existing office assets, with a focus on strong ESG credentials and prime and core locations within key Europe gateway cities. On the whole, its portfolio value stands at around 2.2 billion euros, with over 100 predominantly freehold properties across major cities in your key markets such as the Netherlands, Italy, France, Poland, Germany, Finland, Denmark, and the UK. The total lettable area comes in at around 1.7 million square meters, and its client base well over 800 tenant customers. Now, why are we speaking to Stoneweg Europe Stapled Trust, you might ask? Well, we want to find out how the firm assessed its financial performance for the first half of 2025, as well as how its strategy has evolved through its stapled structure. But on top of that, we also wanted to find out more about the outlook of the European office and logistics property market amid macroeconomic headwinds arising from U.S. tariffs. Well, for more, joining me right here in the studio is Simon Garing, CEO and Executive Director of Stoneweg Europe Stapled Trust. Simon, welcome to the show.
Thank you, Tian Tian. Thanks for having me.
Great to have you on board. And Simon, we've briefly talked about Stoneweg Europe Stapled Trust. Yes. As this stapled group that comprises of Stoneweg E-REIT and Stoneweg Business Trust, how would you describe the stapled trust's value proposition and business model today? How has it changed over the years going back to Cromwell E-REIT days?
Right. Some great questions there to start with. As you said in the intro, we invest predominantly in prime logistics and commercial assets across Europe. Very diversified portfolio. Our largest tenant only accounts for 4% of total rent. Mm-hmm. So investors in Singapore benefit from the resilience of having over 1,000 leases. Investors also have the benefit, as you said, 93% of the properties are freehold. Mm-hmm. That means from an asset enhancement perspective, we can undertake the AEI within our portfolio, and that provides more value for unit holders. And that came through in the first half results. Mm-hmm. We were able to deliver almost 12% rent reversion, which drove like-for-like property income of almost 5% and led to the third half in a row of value enhancing, and our NAV increased almost 4% to over €2 a unit. So investors benefit from the resilience of the income as well as the ability for us to unlock some of the value from our freehold properties for investors to benefit from.
How has that value proposition, though, changed from the Cromwell E-REIT days before the acquisition?
Yeah, so at the end of last year, Stoneweg is a Swiss-based real estate fund management group. So one of the key changes is we've gone from an Australian sponsor to now a dedicated European sponsor. Mm-hmm. They understand what's going on the ground. They have 300 staff throughout the countries that we operate in. So while there are 10 Singapore REITs that invest in Europe, we're by far the largest and with the deepest pool of local talent. We call truffle hunters because they're out there looking for assets.
Sniffing out the good deals.
They're sniffing out the good deals.
Now, let's talk about your investment mandate then, Simon, because the Stapled Trust has a principal mandate to invest, whether directly or indirectly, in income-producing commercial real estate assets across Europe. So, in particular, what's worthy of note is that the trust needs to maintain a minimum portfolio weighting of at least 75% to Western Europe and at least 75% to the light industrials or logistics and office sectors. What was the rationale behind the weighting? How far has it served the Stapled Group well thus far?
Yeah, so we listed back at the end of 2017, and this was before a number of factors that have occurred, obviously COVID in 2020. So one thing that we did in around COVID was we really lifted our exposure to Western Europe. So we're now 86% weighted to Western Europe and the Nordics. And then obviously with the issues in the Ukraine since 2022, we've also reduced our exposure to Central Europe. So two things that came out of COVID. The first was the move towards e-commerce. So we pivoted around 2020 to logistics. Prior to that date, we were only 30% weighted to logistics. We're now heading towards 60% and more. So we're taking advantage of the trend, the major trend in logistics and last mile delivery in particular in cities like Paris. And the second major structural change is obviously the work from home. And that has meant more of a flight to quality of office buildings and B-grade buildings that may have appealed because they were lower rent no longer have the same appeal as employers are looking to look after the health and well-being of their employees. So again, we've been trimming our weighting to B-grade assets and business parks, out-of-town business parks, which are no longer in the same level of demand as they were pre-COVID.
Now, on top of investments, you also take on asset enhancement and redevelopment projects for existing office assets. And there is a strong focus on ESG credentials in prime and core locations within key European gateway cities. Now, question though, if we look at the business verticals, how far of your group's business, be it profit, be it revenue, comes down from real estate investment versus asset enhancement projects? Which is the most important vertical when it comes down to finances?
So the resilience of the income stream is what investors are looking for, and it's what banks are looking for, and it's what our bond investors are looking for. So we will do what we can to retain tenants on very long leases. So the advantage of investing in Europe is we can have leases that go between 10 and 20 years. So that really provides income security. The second aspect is all of our leases have inflation escalation. So it doesn't matter if the market's up or down, each year we can get that inflation at a minimum. The third aspect for our income growth comes from the rent reversion. So this is when the lease expires and we reset the lease to either the existing tenant or the new tenant. And in the last 5 years, we've been averaging around 5 to 6% per annum in rent growth. Now, the highlight of this period's results was we delivered almost a 12% rent reversion. And this comes to the second part of your question, which is the advantage of ESG is twofold. Tenants have their own net zero carbon footprint aspirations, so they look for buildings that are energy efficient. When I started this role, none of our properties, office properties, had BREEAM certification. Now today, 7 years later, 84% of our office buildings have a BREEAM certification of very good or higher. Yet in Europe, only 20% of the total office stock has the equivalent ESG credentials. So we're winning market share as tenants in the market are looking for these energy efficient and high amenity buildings. An example is our recently completed redevelopment of an office building in Milan called Navesa. That is now, post our refurbishment, the second most energy efficient office building in Italy. So it's great that a little Singapore REIT now owns and developed the second most energy efficient office building. And with that, we're able to attract the likes of Universal Music Group for their headquarters to come into this building. So again, this concept of office is not great. In fact, that's not the case in Europe. If you have prime office that it's energy efficient with great credentials, we were able to double our rents. So when it comes to rent reversion, tenants are willing to pay a much higher rent for a higher quality of building, and that translates into better returns for our unit holders. They get a better yield and they get asset value and therefore NAV growth.
So basically you do not split out the asset enhancement projects in terms of revenue generation, but you factor it in terms of the value add to your existing rental reversions.
Yes, we look at it in two ways. We have our ongoing ESG upgrade, so we would invest maybe 6 to 10 million per annum across our portfolio, and that could be things like LED lighting, better insulation, and so that saves energy costs for the tenant. That means the tenant can then pay us more rent. So if they're paying less in energy, they can pay us more in rent. So we get a return on putting, for example, solar panels on our roofs. The second aspect is the major repositioning. Our largest tenant, National Nederlander, a couple of months ago signed a new lease to pay substantially more rent for us to refurbish the building. So they will stay in the building while we're doing the refurbishment, so we won't have any loss of income during that period. So it retains tenants, and in fact, in this quarter, we just announced a 96% tenant retention. So the tenants are happy. They're happy to stay with us, and they're happy to pay us more rent. And this really goes not just to the quality of the properties, but the quality of the Stoneweg executives on the ground, speaking the local languages, sending their kids to the same schools, having the local networks. It's a really important part of real estate. It's not just about location, it's also about the people.
I do want to talk about your global presence, because if we look at Stoneweg Europe Stapled Trust's portfolio, value stands at 2.2 billion euros. You've got over 100 predominantly freehold properties, and you're located in major gateway cities like the Netherlands, Italy, France, Germany, Denmark, and the UK. Ultimately, which is the most important geographical market for you when it comes down to your asset exposure and your income generation?
Yeah, our largest exposure is the Netherlands. It's a very modern economy, very innovative. Some of Europe's largest companies are headquartered there, and that's a very important market for us. We have some great assets right in the heart of Amsterdam, in the heart of The Hague, the heart of Rotterdam. So it's a very important part. It's also a part of our portfolio where we have a number of development opportunities, and this is one of the reasons we created the Stapled Trust. Another innovation for Stoneweg this year was we had 99.8% acceptance of our unit holders to create a Stapled Trust, to put a business trust next to the REIT. What that enables us now, it provides us with some more flexibility when it comes to things like development, like energy procurement. So we have a little bit more flexibility. We can redevelop assets and sell them. Under the Singapore REIT rules, we need to develop to own for 3 years. But in the business trust, we have a little bit more flexibility that if someone comes along and actually wants to buy one of our buildings that we've just repositioned and pay us a substantial premium, we can now accept that offer. And there's actually some tax advantages in the Netherlands for us to do so. So Netherlands is a very important country for us. We've got a lot of opportunities there, and we've got some great assets that any of your listeners are in Amsterdam, we would really encourage them to go to see some of our assets.
And you talked about Stoneweg E-REIT or Stoneweg Europe Stapled Trust as a REIT that is based here in Singapore, listed on the SGX as well. So what is the role of Singapore against your wider portfolio? Is it just solely a market for you to manage your capital raise and corporate activity? And if so, has there been enough liquidity to support your capital needs? As much as we like to say that SGX is known to have a supportive environment of REITs here.
Yes. So look, first and foremost, we had the choice back in 2017 on a number of stock exchanges to list the REIT. We selected Singapore in part because of the sophistication of the investor community here. Certainly, it's a very established REIT market. At that time, Singapore investors did not have the ability to access Europe. Europe's one of the top 3 economies of the world, just slightly behind US and China. Yet there was a very few opportunities for Southeast Asian investors to access that economy. And it's a very widely held real estate market by foreign investors, but not the opportunity here in Asia. So we thought that there was an opportunity to provide that diversification. And then finally, the Singapore exchange and regulators are very supportive of foreign REITs like ourselves. So, we can't thank enough the regulators. They work weekends, they work overtime. So when it comes to capital raising and it comes to initiatives like stapling earlier on this year, everyone bands together. I'm a member of the REITAS Association, and again, as an organisation, it's a very well established, very well credentialed market. It's obviously a large part of the SGX, and so it was a natural place for us to list. In terms of the liquidity, we've done a number of equity raises, pref issues, placements. We've issued a perpetual hybrid note. So we're very pleased with the liquidity here. And this is actually what attracted Stoneweg to our REIT. So they were looking globally for an opportunity to get into the management of REITs. They have one particular REIT in Switzerland that they manage. So we are now the second that they sponsor. And they were also attracted to the Singapore market to grow from. So I know we're very happy here.
I see. Now, I do want to quickly look at your customer base before we move on to talk about more exciting things like earnings and strategy. Stoneweg Europe Stapled Trust has over 800 tenant customers. You mentioned some of them as well. Who are these customers? Which is the most important segment? What is the average deal size, rental duration, renewals, or positive rental reversion rates we're looking at here?
Yeah, so go back to the investment proposition, for REITs. Investors are looking for income predominantly. They're looking for stability of income with some growth. So we've deliberately designed this portfolio to be very resilient. So our largest tenant only makes up 4% of our rent. Our top 10 tenants only make up 20%. So as the CEO of the REIT, I'm not worried every morning when I wake up to see that there's been an issue with one of our tenants because we're not relying on one particular industry sector either. So we're not heavily reliant on the financial industry. We're not heavily reliant on the automotive industry. 93% of our tenants are either multinationals or government tenants. So if we think about 2020, which was a very difficult period for everyone, we only lost €500,000 of rent on a total rent roll of 150 million. So the tenants that we have kept paying their rent. Even if they were in lockdown, they would keep paying their rent. And that's the sort of resilience that I think over the long term we've delivered it from a track record perspective, that having such a wide mix of high-quality tenants means that investors who may not be as familiar with the countries that we're in at least can understand that we have no single reliance on any particular segment of the market. Some of the major tenants would include a KPMG or a DHL or a UPS. We have a number of e-commerce companies. ASML, people would be familiar here as the world's largest designer. So we have a lot of tenants like that. And then utility companies. We have the largest energy provider in Germany and Netherlands called Essent. We have Aramco. Many of your listeners will know that company. So it's a really good mix and not one particular element. We think of our data center tenants. So we've just invested in a data center initiative of the sponsor, which we can talk about. But again, that's got a lease to one of the largest US hyperscalers. So there's plenty of resilience and credit, which supports our recent S&P and Fitch ratings, where we're an investment grade. So this was very important to our bond investors.
Yes.
We have a public bond, which we issued earlier on this year. Bond investors are even more critical of the credit profile of our tenant base.
Okay.
And they were very happy with our portfolio.
And speaking of which, let's talk about where things are at for Stoneweg Europe Stapled Trust right now. I mean, you reported financial results for the first half of 2025 not too long ago. Distribution per stapled security was down 7% on the year. So how would you assess the firm's latest performance, gearing, valuation, and leasing activity? What are the key engines of growth right now?
Yeah, so firstly, the result was in line with market expectations.
Okay.
Like most REITs, we're recycling debt from when interest rates were negative. So it was very well known that over a period of time, as our old debt matured and we would have to reset to the new levels, that would come at a cost. And in the last 2 years, unfortunately, our distribution has reset because of the rise in interest rates. But the market now sees this as sort of the peak in our interest rates, and that we can now start to enjoy the benefits of the recent ECB rate cuts.
Okay.
The ECB rate cuts have also driven a return to the positive valuation cycle. So one of the reasons the euro is up 6% versus the Sing dollar, one of the reasons the European stock markets has been the best performer this year is because of the monetary stimulus that the ECB put in about 18 months ago. And so that's now starting to play through. So that drove our NAV growth as it was our third half of positive property valuations. And so we're in that early uptick in the cycle, and this is really positive for investors, and it's what's been behind the recent strength in our share price. We're up about 16% in the last 12 months, outperforming the market because, again, we have that diversity in Europe, and Europe at the moment is seen as a really interesting place for investors, not just in the listed market, but also in the direct property market.
And you've mentioned this in brief as well. I do want to take some time to look at this, which is the strategy ahead for Stoneweg Europe Stapled Trust. Because in June 2025, there was a conversion of Stoneweg E-REIT into a stapled group. What synergies are there between Stoneweg E-REIT and Stoneweg Business Trust? How have you unlocked them in the months since the conversion? How will the strategy change?
Yeah, so there's a couple of reasons why we made the proposal that was unanimously adopted by our investors. The first is around the tax side of things. Tax is very complicated, and we needed to have a more modern structure to hold some of our assets in. And so you'll see in the next 12 months us move progressively to take advantage now of these more efficient structures that we can put through the business trust. The second is around specific incentives. As I mentioned before, we have a great development project in the middle of Amsterdam where the Dutch government gives us an incentive which could add around 17 million euros of value if we were to move that property from the REIT to the business trust, in part because it enables us to sell the building during a development which we wouldn't otherwise be able to do under the REIT. So that unlocks some value. And the third is our very recent investment into the sponsor's data centre private fund. This is an amazing opportunity for Singapore investors to get access to a private fund of Stoneweg's, which has now 5 mega data centre development projects. And that, of course, comes with power, with electricity. And through the business trust structure, it's more acceptable under that structure to be more of an active player in the energy market. Under the REIT rules, it's a little bit more grey, but at least now we're very black and white in the business trust. Solar panels will generate electricity, and we can then trade that electricity when, for example, the tenant in the building doesn't want to use that electricity. So from a tax and regulatory perspective, we also have the flexibility now on more to do with our solar panels. And as you mentioned, we're a 1.7 million square metre portfolio. This is a substantial size, and that's a lot of roof. And so that's a lot of solar panels. In France, for example, now, if you have a car park that's got more than 100 spaces, you need to put a solar panel roof on your car park. So what do we do with that electricity that we generate? So investors will be able to benefit from some of these rules that we can now conduct proper business and establish proper business protocols through the business trust.
And let's talk about the road ahead, Simon. The Business Times, in a report by the paper out in March 2025, it noted that European commercial property deals rebounded in 2024 after 2 years of contraction. So if we go by MSCI data, in that report, we saw a busy fourth quarter with transaction value totaling 55.6 billion euros, around 80.3 billion Sing dollars. But as we know, 2025 proved to be a very challenging year. There's US tariffs weighing on global growth and economic activity. So I would like to get your take on this. What is the outlook for the European office and logistics property market right now? now. Amid such macroeconomic headwinds, is it a time for you to seek out good deals?
A lot of points in there. Firstly, global investors are pivoting to Europe. We are seeing a substantial increase in interest in real estate, and you saw that in the stats around the transaction volume. One of the reasons is the ECB cutting rates over the last 18 months. We're now able to borrow at sort of 2% base rates, and if we're buying real estate at 6 to 6.5% yields, that spread is very wide. So we're able to generate higher yields to investors, higher dividend, higher return on equity.
Yes.
And in fact, recent DBS research shows that the Stoneweg Europe Stapled Trust delivers the fourth highest return on its equity relative to the rest of the Singapore REITs. And this is primarily because we're able to buy property in the early part of the upswing. So, as I said, we're only 18 months into the upswing. So real estate is still relatively good value versus the previous peaks. We're in the early stage of recovery, and now we're able to access debt, credit at very affordable levels and take advantage of that. So when we look at our pipeline, so the second part of your question about the future, we have a track record of recycling. We have a track record of selling up to 300 million euros in the last 4 years at a 12 to 13% profit to the valuation at the time. So again, our truffle hunters are great at buying assets, but they're also very good at selling assets at a premium. So we'll continue to recycle assets that we think we've either captured the value from our active leasing program, or where perhaps the risk in a particular property is not up to the risk appetite of the board. We have a very rigorous risk assessment metrics. And so when we look to buy or sell an asset, it's not just about the potential return, it's about the risks. And so that's something that we will continue to focus on. We're very driven by dividend growth. So if we do buy something, we need to make sure that it's enhancing to unit holders.
Yeah.
That being said, we're on an 8% yield at today's price. So there's already a higher yield in our REIT versus the rest of the average of the REIT sector. So again, anything we look to buy will need to be accretive.
Now, if you're just tuning in, we're now in conversation with Simon Garing, CEO and Executive Director of Stoneweg Europe Stapled Trust. Going forward, Simon, what's your take on corporate sentiment and capital expenditure plans from your occupiers across key European markets? What are the bright spots for 2H 2025?
Yeah, so last mile logistics is still very popular, and it's still very much an invested sector, and this is the rise of e-commerce and the fact that consumers now don't want to wait a day for their delivery. They want it now. They want it within 2 hours. So in our largest asset, which is in Paris, it's 10 hectares of land, 3 kilometres from the Champs-Elysees. Fantastic location. And rents there continue to increase. When we bought that property, rents were about 90 euros a square metre. We're now hitting 180 euros a square metre, so doubling. So when people think Europe's low inflation, actually if you're in the right locations in the right markets, rent growth is pretty exciting. And so that's something that we'll continue to focus on is the last mile. And what do I mean by, who is the tenant in that sort of piece? It could be DHL looking to do short-term delivery cycles, or the post office. It could also be Louis Vuitton, who might keep their shirts in our warehouse and have a man on a bike going to the Champs-Elysees when someone wants a double XL shirt. But they pay a much lower price. Even at 180 euros a square metre, it's still much cheaper than 5,000 euros a square metre on the Champs-Elysees or Georges V. So that's still a very important part. And then with all of the issues around rising house prices, Singapore's not the only market where we have higher housing prices, then there's a lot of demand for building materials. And so a number of our tenants need to be closer to where all of the residential construction is happening. So again, we see a lot of demand from a number of different industry types, all looking for very rare pieces of real estate, which fortunately, in our portfolio, we have around 20% is in last mile logistics in places like Amsterdam, in Paris, in Munich, etc. So that's really providing strong rent growth, and it's an area where our tenants continue to invest in. Office is also an area where our tenants will invest in, and this is really around the health and safety. Having just come back from a time in Europe during heat waves, living in Singapore, we take AC for granted. I can tell you in cities like Geneva, AC is actually banned. So if you've got an ability to cool your office, then you've got an advantage over others. So again, come back to the investment in our buildings is one way of keeping the tenant base.
And in the meantime, in June 2025, Stoneweg Europe Stapled Trust injected 50 million euros into its sponsor. Now, in July 2025, the sponsor then acquired a fifth asset under its data center fund. Tell us more about the move. Are such partnerships your way or the Stapled Group's way of dipping its toes into AI data centers? How many more of such moves do you have in your pocket right now?
Yeah, so we have 2 data centers already in our portfolio, and we were really fortunate when Stoneweg became our sponsor and major investor, because they have one of Europe's largest development funds for data centers. These 5 assets already control 1.5 gigawatts of power. That's 20 times the size of the recent IPO here in Singapore of another REIT, and they have and this particular fund also has applications in for another half a gigawatt. So, put it in perspective, 2 gigawatts is 20% of the total market in Europe. So our fund controls the size of 20% of the power that's already required in the European data centre. So there's an extraordinary opportunity for Stoneweg Europe Stapled Trust investors to get access into this potential. One of the projects already has a lease to a major hyperscaler. We've already started the construction of the first phase. And so if we build these 5 projects out over the next 10 to 15 years, that's a 30 billion euro development pipeline. Now, at the moment, the REIT only owns 6.7% of the fund. But we'll continue to assess our ability to grow inside the fund. We want to do this gradually. We are predominantly still an income fund, but we need to look for more innovative ways to provide growth to our investors. And we think this is, a pinnacle of the growth engines that's available for real estate investors at the moment. And we're very fortunate that we're able to invest into this fund.
I'm putting a couple of questions into one in light of time constraints, but I do want to talk about them in the short term. Where are the opportunities in terms of capital recycling or reinvestment? And in the longer term, what are some of your priorities and long-term targets?
Yeah, so we're continuing to pivot to logistics, light industrial and data centres. We're about 60% weighted there. So we'll continue to look to increase our weightings through the acquisitions or through developments and expansion of existing sites. The second part of the strategy is within our prime office portfolio, which is now less than 40% of the portfolio, but we still have a number of value-add development opportunities. And then the jewel in the crown is our Parc de Dock Paris asset. And that's 10 hectares of very special land. One of our major investors went and visited the site, came back with a Chinese proverb that translates something like, don't pluck the fruit from the tree until it's ripe.
Okay.
And so, his advice was, look, this is such a prime piece of real estate. Make sure that you get the planning right. Make sure you get all of the stakeholders lined up. This will be one of the special projects in the Singapore REIT space. This is in Parc de Dock.
And finally, before we let you go, Simon, what are some future plans for Stoneweg Europe Stapled Trust for the rest of this year or into the next? What can investors here on the SGX, trading on the SGX, look forward to then?
So the first is we're providing a very resilient yield. So if you can't get excited about an 8% yield when the SORA is at 1.6, that in itself is exciting. So we need to ensure that the investors have the trust and take our transparency and governance and look at the yield and look at the discount to our book value. So that's the first aspect. The second is we're able to drive rent growth. We're able to retain tenants. And so from here, now that we've reset our debt, we should then be able to start delivering the dividend growth, which is kind of what's now happening in Europe with the excitement around the European stock market and the euro currency. We'll continue to invest in our development book, which will have some very exciting news over the next 6 to 12 months. So we're very conscious that investors, are looking for REITs that progress, and so we have a number of milestones that we're very excited about bringing back to the market and letting the market reassess the risk return of these opportunities.
I see. Thanks so much for the insights, Simon. That was Simon Garing, CEO and Executive Director of Stoneweg Europe Stapled Trust. Thank you so much for joining us on Money FM 89.3.
Thank you very much, Tintin, for having us. Thank you.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.